Hello guys, and welcome back to another episode of Hot Money Topics, where I break down the key financial news for the month that's just been. As always, let's kick things off with looking at what the key indices did last month. The Australian stock market had a good month, with the ASX up 1.68% in July. That gives us a 12.16% return year to date. US stocks also did well, with the S&P 500 and the Nasdaq both rising. The Nasdaq has again outperformed the S&P 500, which means that there's still some appetite out there for growth stocks. Maybe at the moment there's less concern about inflation and more concern about the resurgence of the Delta strain of COVID, because some of those large tech stocks can actually benefit from additional lockdowns. Gold has bounced back a little from a shocker month last month, and iron ore is down quite a bit this month, but still sitting at $191 per ton, which is high on historical valuations. The US 10-year Treasury yield dropped by 0.23% this month, and this is something that I want to touch on in a little more detail. As you can see from this graph, bond yields have been rising over the last year up until about April, and then started to drop, particularly in July. When bond yields drop, it means that investors are buying bonds because there's an inverse relationship between the price and the yield. So when investors buy bonds, the price goes up and subsequently the yield drops. Now, this can be an indicator that investors are a little bit concerned about markets, because one of the reasons you would buy bonds is if you're expecting the equity market to drop, because bonds are a relatively safe asset. So the fact that the yield curve rises may be an indicator that a lot of people out there are a bit worried about where the market is at the moment. So what are some of those risks that are in markets at the moment? Well, there was a really good discussion last month between Hamish Douglass and Michael Morrell, who is the former deputy chief of the CIA. They talked about trade tensions with China, the conflict between China and Taiwan, inquiries into the origins of COVID-19 and the emergence of the Delta strain, growing cybersecurity threat from Russia, and even political tensions within the US. So while it is good to make note of some of these risks in equity markets and tweak your portfolio slightly to allow for some of those risks, you do have to remember that markets always come with risk. And at the end of the day, some of those risks might eventuate and equity prices might fall, but investing is a long-term game. And provided you hold good quality assets, one, they will rebound, and two, when the equity market drops, it really should be seen as an opportunity to buy some more of those good long-term assets while the prices are cheaper. One market that I don't talk about too much, but I think it's worth mentioning here, is the Chinese stock market. If you have a look at the CSI 300, which is the top 300 stocks on the Shanghai Stock Exchange, it fell 5.5% last week and ended down nearly 8% for the month. This comes off the back of tighter regulatory actions. We previously saw Didi and Alibaba slapped with tighter restrictions when Didi, the ride-sharing app, was ordered to be removed from app stores in China because of violations in the collection and usage of personal information, just a few days after its IPO. Alibaba, the country's largest e-commerce company, was hit with a $3.6 billion fine for supposedly abusing market dominance. Now the Chinese Communist Party has set its sights on private education companies, stating that any company that provides after-school care for children needs to become not-for-profit. Now, this is because China is trying to encourage people to have more kids, because there's a bit of an aging population problem potentially in China, which they're trying to fix. And one of the reasons people stated they're only having one kid is because they're saying it's too expensive. So this is one way the Chinese government are trying to encourage people to have more kids, but unfortunately it is not good for the stock market. All of this additional regulation has spooked investors because it creates a lot more uncertainty when investing in China. And as a result, you're going to want a better or higher risk premium. Now, in our portfolios, we don't have a huge exposure to China simply because the market and political dynamics over there, you really need to know what you're doing and you need to have a strong understanding of it to be a successful investor in that region. But that's it for this episode of Hot Money Topic. Thanks a lot for watching. And if you're watching this one from Sydney, then I really feel for you guys. Extended lockdowns can be really hard on businesses and individuals alike. And fingers crossed that it ends soon and you can all get back to life as normal.